around Russia. We've also shown, let's say, how important it is to have a single legislative framework, for example, for securities and securities transactions. We have clearly said, that no securities transactions could happen of securities which are owned by Russians, which have it in a custody in Europe. So we have used a large set of powers to really react against this war in Ukraine, and I think that is extremely important. And we are happy, let's say, that we can discuss this with this panel, which is, I think, a good combination of people. We have, first of all, Michael Hager, who's just joining us from the European Commission. Michael is the head of cabinet of Commissioner Dombrovskis. Michael, I'm just introducing the webinar. We then have Caroline Roulet from the OECD. We have Satnam, who's with the Danske Bank, and we have Timothy, who's from Ukraine, who's a former Minister of Economics of Ukraine, but is with an international group on sanctions, which is called the McFall International Group on Sanctions. So I think this should make a great webinar. We, of course, in CEPS have worked on this with several people. We have looked at this from the financial angle, also from the trade angle. I have published a commentary on this. Willem, my colleague, who will take over in a moment, has also focused much more on the banking, specifically on the banking sector. We have another colleague, Tina, who's focused on the trade dimension. So also for us as a think tank, this is an important thing to follow, and we will certainly continue to follow this. So with this, Michael, I would give you the floor. I mean, happy that you could join us today. If you could set a bit where you see we are today with the sanctions, what you see coming. There was an article today in Reuters, is a 7th package already coming? But above all, if you now look backwards on this six packages, what have you achieved from your perspective? What are the problems? There's a big debate also about implementation at the level of the member states, where we see a huge diversity. I hear that the Commission doesn't have data from all the member states yet about how much has been frozen so far. So if you could probably go a bit into this, but also other issues which you see from your perspective, which you can share with us. And then, of course, we can have a debate with the others, Caroline from the OECD, person from the banking sector, person from the sanctions, which will then take over. I will come back at the end also with interjection questions, but we'll also have questions from the audience. We had about 100 people registered for this webinar. I see there are already close to 80 people which are online. So welcome to all. And if I can, I will pass the floor to Michael. But I can interject some questions, Michael, and then my colleague Willem will also take over, let's say, with the other speakers. Floor is yours, Michael, if you're ready.
Thanks a lot. No, and thanks a lot for the invitation, and thanks a lot for the organization of this, which comes indeed at a very timely moment. Yeah? I mean, as you said, there are the rumors of the next package going around. There is, of course, the 6th package adopted after whatever, some wriggling and some difficulties. But maybe to go back and just to see a bit what we're talking about and what is at stake. So we had already since 2014, after the illegal annexation of Crimea by Russia, imposed certain sanctions. So it was a first test case for us how this could happen, how this could work, how this is to be implemented, how to agree on these things. All limited scale, all, what I would call, first steps, baby steps, how we can do these things, and certainly not with the impact which would cause a withdrawal of Russia from Crimea. At that moment, also the political environment was different. So to factor in that playing hardball at that moment in time was certainly not the real thing we wanted to do. Everything changed now with the end of February and the invasion of Russia into Ukraine. Of course, the whole setup is completely different. And there was a push from the very first moment that we do much more than we have ever done. And that on all fronts, on all sectors, on all sides. So not only what we did so far, listing certain individuals. We have done that also in other cases, but okay, now we did it, and up to the sixth package now, I think we have almost 1,200 people listed. We have listed companies, we have export restrictions, we have import bans, so the classical trade area is covered well. But we also have financial sanctions, so the freezing of assets of the central bank. We have the operational bans for certain banks. We have the de-swifting of some. So there's a broad variety of measures we have taken, certainly not affecting neither 100% of the trade relations nor 100% of the financial or the assets of Russian banks, but a big chunk. So when it comes to exports, it's 57% or something like that. On import side, it's also above 50. So it's remarkable and it's very targeted. So the idea is, of course, to deprive Russia of technology, of the capabilities, not only to invest in the war, but also to develop or innovate when it comes to the energy sector, when it comes to other sectors like aerospace and so on. And of course, military. So all the dual use things, of course, we also need to factor in. So covering that broad range and to a large extent showed that we are capable of agreeing and capable of then also pushing forward, call it sensitive sectors like the energy field. So what we have in the sixth package, the oil import, which was the biggest discussion in the council, led to a situation where the seaborne oil is cut off, where we have certain exemptions for some landlocked countries, which are very much dependent on the oil streaming through the pipelines. But I think the signal is clear that we are also not shying away of tackling, and coal we did already, another fossil fuel, depriving Russia from income in that sector, which is, I think, 70 billion euros. So now, when it comes to the question of how the reaction is to that and how the implementation works, I think we need to have a close eye. One of the points, and I think this is, of course, also a lesson we have learned, to take business on board. We need to make sure that this is understood, that businesses understand what they have to do, where to turn to, how customs authorities interact, and to avoid that not only circumvention is done, but also that the proper application is made, and to make sure also that there is not the over-fulfilling necessarily done. So that is one important element. The implementation is checked. Customs authorities are working together. We had several seminars, we had several interactions. So there is a platform of discussion which helps to keep the implementation at a very, very high and satisfactory level. Nevertheless, of course, and this is what we do every day, we check and look whether there are loopholes and whether they need to be corrected, which would then also be part of a seventh package. So it's not only looking at the implementation, it's not only looking at the loopholes, it's also to make sure that all the players understand of what they actually need to do and should do. Maybe another point when it comes to the discussions, of course, when I look to the member states and the various interests, it is also important to see up front when we put out a sanctions package, what is the pain for different member states? Because we need the buy-in, and we have seen now in the latest round of the 6 sanctions that in particular one or some countries had severe problems and which led to certain adaptations. So taking this into account, coming out from the outset with something which is not only solid and encompassing, but also which reflects sensitivities and reacts to these sensitivities, is of crucial importance. Now, when we talk about the next steps or what could be done still in the future, I think we were clever enough, not to put all the cards on the table, not to play with everything we have, because we see, the war continues, and B, the atrocities continue. So we need to have further cards in hands to play at the right moment with the right effect. Of course, the big elephant in the room is still the remaining fuel questions, and I'm avoiding the fossil fuel, the fuel questions, because I mean there is also, or there are two issues. Of course, there is gas, which is a different commodity than oil, and there is the nuclear fuel, as we know. In particular, in Eastern European countries, the nuclear power plants run with fuel from Russia, which you cannot replace simply like going to the next gasoline station and take whatever the diesel from a different company. It is not possible to do this, so it requires a lot of well, it would have an impact of designing actually new reactors to allow for other fuels, other nuclear fuels to be used. So these two elements, of course, we are discussing, and we are seeing with member states what can be done, what should be done. In parallel, we also have done a lot. Take the Repower initiative to make sure that we get out of Russian fossil fuels in a very quick exercise, or as quickly as possible. But certainly that is not possible tomorrow. And we have also to look at our security of supply and ensuring that not only the businesses are running and the high intensive or high energy intensive industries, of course, are reliant on a proper flow of their fuels to make or keep the production afloat. But we also need to see that the next winter, of course, is under control. So consumers, that we don't run into a situation where, certain interruptions of gas or a ban from our side of gas imports would cause difficulties in certain member states, as this, or in all member states probably, as of course the heating situation depends a lot in Eastern Europe mainly, but also somewhere else, on gas imports. So all that we have to factor in, as well as, and I said this at the very beginning, we are covering roughly 50% of imports, roughly 50% of exports so far. So there is further things which could be put on the table. So still there is margin of maneuver we could play with. Now, of course, one important element or a principle, I would say, the sanctions should hurt the counterparty more than ourselves. And that is a very difficult exercise. And the more we get into the, as I said, fossil fuel question, this has not only implications for us, it has implications for global markets like the oil market. It has implications for a gas market which is differently organized. But I mean, what we need to avoid is that there are, we see this already, price hikes. The energy question, energy price question is a very dominant one in the media. So all that we need to factor in when designing any next step. Overall, I think if I see and I mentioned at the very beginning the 2014 sanctions and what happened in between in other areas like Syria and so on, this is the first time that we really use the toolbox to its almost full extent. And I'm not surprised, but positively touched by the level of cooperation we have seen throughout the process. So there was an alignment with the partners when we designed the sanctions. They're not fully compatible. They're not fully or 100% overlapping, but there's a broad alignment of sanctions when it comes to what I would call the friends. So the like-minded, our US partners, Canada, and so on. But we also see that there are quite some, and we have seen the voting in the UN. We have seen the discussions we had in other international fora, like the WTO last week as well, that there is not 100% alignment when it comes to how to deal with Russia. One element there, India, dependent to a large extent when it comes in particular on weapons and weapon supply on Russia. Of course, there's a different attitude and a different view. There is also the question of food security, not 100% related to sanctions, but as food and medicines and so on, humanitarian stuff is outside the scope of the sanctions. But still, we need to have in mind that there is a spillover effect, and the current spin, in particular, played by Russia in Africa, points to the sanctions as the cause of a food crisis. And this narrative we have to counter. There we have to do much more outreach, explanation, but also certainly help and making sure that it is understood that we are not the stumbling block. It's Russia, the aggressor, also bombing the wheat storages in Ukraine, stealing wheat. That Russia is the point to turn to. So also that, call it the disinformation side or the communication efforts, we have to have in mind to have a successful sanctions implementation and a successful sanctions design. So I think I stop here. I covered a broad range of things. Let's see how the others react and what the discussion will bring. Thanks a lot again for inviting me.
Thank you, Michael, and we will come back to you after we have had the interventions from the other panelists. If you have a question for Michael, please use the Q&A button at the bottom of your screen. Hopefully at the end of the round with the panelists, we have some time for that. We now will move to Caroline, and she will discuss the impact that the war as well as the sanctions have had so far, as well as what lessons we can draw from that. Caroline, please.
Thank you very much. So I'm very pleased to have the opportunity to present at this CEPS webinar on the impact of the Russian invasion of Ukraine on global financial market conditions and resilience. Today, I will start my presentation by focusing on the major impact of the conflict on financial market conditions, and then I will discuss key vulnerabilities and threats for financial sector resilience. Before starting, I have to say that at the OECD and its member countries, we do not have views on the sanctions themselves and how they should be set. We only assess the potential impact of sanctions and consequences for a range of sectors, markets, and policies. So now let's turn to the consequences of the sanction on financial market conditions. Next slide, please. Next one. Next one, please. Thank you. So the Russian invasion of Ukraine has delivered a shock. No, the previous one. Yes, that one. So the financial, the conflict has delivered a shock on financial markets and to commodities prices in particular. As shown in the left chart, prices of oil, European gas, nickel, and wheat have been particularly impacted, as Russia and Ukraine are major global exporters. Also, elevated commodity prices have resulted in higher market inflation expectations, as shown in the right chart. In the last economic outlook published in June, estimates suggest that an embargo on gas supplies from Russia would hit growth and raise inflation, particularly in Europe. Also, the ban of Russian seaborne oil imports to Europe is likely to push up global oil prices further in 2023. Against this backdrop, world economic outlook growth is expected be 3% in 2022, down from the 4.5% projected last December, and it will be 2.75% in 2023. Inflation projection now stand at nearly 9% in OECD countries in 2022, twice of what has been previously projected. To address inflation pressures, a number of central banks have started to unwind their asset purchasing programs and also increase their policy rates. In turn, supply disruption and elevated commodity prices over already high inflation globally that could erode consumer purchasing power, corporate production capacities and earnings, dampen economic activity, and add to downside risk for market and intermediaries. Next slide, please. Global equity market prices have also recorded a substantial decline, as shown in the left chart. They remain lower in emerging markets, most exposed to Russia and Ukraine, amid concerns over the impacts of elevated commodity prices and weaker outlook for corporate earnings. The shock has triggered a spike in volatility in a range of markets, such as equity, oil, and treasury securities, as shown in the right chart. While volatility on equity and oil markets have declined, volatility on treasury markets remain elevated, as investors are increasingly concerned about the acceleration of monetary policy tightening. Next slide, please. Spillovers have also affected sovereign and corporate credit markets. As shown in the left chart, Russian sovereign CDS spreads has increased to elevated levels following a number of rating downgrades to near status default. Concerns are rising about the Russian government debt ability and willingness to continue paying its foreign currency denominated debt. Sanctions have created challenges for the trading of Russian sovereign bonds, as banks have ceased transacting Russian government bonds following the ban implemented by the US Treasury in June that prevents American investors from buying Russian securities in the secondary market. Also, sovereign CDS spreads have increased significantly in several Eastern European markets amid concerns about weakening economic conditions and possibly waves of migration that could require additional fiscal spending. Turning to corporate credit market condition, a spike in investors' risk aversion has resulted in tighter conditions. As shown in the right chart, speculative rated corporate bond spread widened amid rising corporate debt sustainability concerns. Sanctions have also created challenges for the trading of corporate bonds on international markets. The number of failed trade in the US corporate bond markets has risen significantly since late February, with US primary dealers reluctant to proceed trades involving corporate debt potentially linked to Russia. Next slide, please. Spillovers have also negatively affected stock prices of mainly Russian and European banks, the most exposed to Russia, as shown in the right chart. Russian banks are experiencing acute challenges, including the inability to operate international transactions, depositories growth, and also growing risk of higher non-performing loans, which could cause credit condition to tighten and make the economic pain from sanction even worse. Among international banking sectors, Russia, Italy, and France have the largest absolute exposures. For instance, subsidiary banks of those countries are among Russia's systemically important banks, and their activities have been scaled back or even suspended. Lastly, the rotation to value stock and the declining performance of crypto assets, as shown on the right chart, reflect growing investors' concerns over the economic outlook and their appetite for lower risk assets. Next slide, please. While the length of the crisis and implication are still uncertain, vulnerabilities are rising on several market segments. Next slide, please. Strained condition in Russian and Ukrainian sovereign and corporate debt markets markets could result in substantial losses for a range of financial intermediaries. As shown in the left chart, maturing Russian sovereign debt denominated in foreign currency exceeds to a large extent the part of international reserve at the Central Bank of Russia that could be converted into foreign currencies. Nevertheless, sanctions and capital controls could create difficulties in proceeding payment to foreign creditors. According to a panel of derivative dealers and investors, Russia's failure could pay a slice of interest on one of its bonds could trigger about $2.5 billion of insurance-like contract used to protect against debt defaults. As shown in the right chart, a number of Russian and European non-financial corporates have been downgraded. A lengthy conflict could have broad implications for commodity prices and inflation, with the potential to exacerbate cost pressure and dampen demand. Therefore, risk of higher losses could arise for a range of financial intermediaries and products, including commercial mortgage-backed securities or collateralized loan obligation, for example. Next slide, please. Borrowers' deteriorating credit quality combined with disrupted business activities are increasing risk of higher non-performing loan losses and equity write-offs for Russian and international banks. As shown in the left chart, international banks in major OECD banking sectors are exposed to direct risk from disrupted business conditions of their subsidiaries in Russia and Ukraine, and also from the holdings of Russian securities that have become unsellable. International banks may also be exposed to indirect risk from deteriorating credit quality of their corporate borrowers with tight trade relationship with Russia and Ukraine. And also these borrowers may be affected by the lower growth and higher inflation regimes in this post-COVID-19 environment with intensifying political tensions. Turning to Russian banks, they were already recording highest non-performing loans and lower capital ratio compared to banks in other major banking sector before the war, as shown in the right chart. Nonetheless, deteriorating credit quality of household and corporates could lift NPLs higher. Next slide, please. Emerging economies are likely to be impacted as well, and mainly through commodity prices and supply chain disruption. In fact, energy and food typically represent a greater share of consumer price indices for lower income countries. As shown in the left chart, emerging economies net commodity importers with direct links to Russia and Ukraine mainly include Eastern European, Baltic, and some Central Asian economies. In these economies, inflation pressures could necessitate further monetary policy tightening and additional fiscal support to provide food and energy at affordable rates to their population, risking famine and social unrest. Deteriorating economic conditions are raising downside risk also for highly indebted corporates in emerging economies, as shown in the right chart. And spillovers could be transmitted through interlinked balance sheets of household, banks, and sovereigns. Next slide, please. Last but not least, alternative finance markets are also prone to emerging downside risk from less accommodative interest rate environment and also intensifying geopolitical tensions. Notably, some major stablecoins are vulnerable to a sudden shift in investor risk sentiment amid reallocation towards safer assets. Recent examples include the failure of Terra USD, DEI, and Tether, which have recorded sharp declines in value following waves of redemptions. If the absorption of crypto assets continues to increase, the linkages between decentralized finance and traditional finance may become stronger and possibly increasing the risk of spillover into traditional financial markets and the real economy. The military conflict, implemented sanctions, and deteriorating political climate have also highlighted the challenges for ESG ratings to accurately reflect growing social and governance risk in Russia. For example, despite controversy from past historical events for ESG labeling of Russian assets. ESG-focused funds globally had substantial exposure to Russian assets right before the Russian aggression against Ukraine. Also, as shown in the right chart, empirical findings do not provide evidence that Russia-based companies had significantly lower ESG scores than companies without that exposure. So while the challenges of ESG rating methodology to foresee the deteriorating political climate in Russia would not be qualified as an ESG weakness, these outcomes certainly cannot be presented as a strength for the current methodology. Last slide, please. Overall, global financial markets have been resilient following such an unexpected shock. Nevertheless, conditions are deteriorating in certain market segments, and higher policy interest rates, along with global inflationary pressures and a deteriorating economic growth outlook, could expose the vulnerabilities that have built up from higher debt and elevated asset prices. Rising financing costs, in particular, could affect the repayment capacity of firm and household in the medium term. It could also limit the ability of sovereign issuers in certain jurisdictions to provide additional fiscal support. Tighter global financial conditions and higher risk aversion in tandem with the impact of the war in Ukraine could aggravate potential vulnerabilities in emerging market economies from rising interest rates and capital flow reversal. Thank you very much.
Thank you very much, Caroline. If you have a question, please use the Q&A at the bottom of your screen. We move now to Satnam. I mean, you have had quite an impact of the sanctions, of course, on your daily works. How did it go, and what are your challenges in implementing the sanctions?
Well, thank you very much. And so, you know, we as financial institutions are at the sort of forefront of actually implementing public policy when it comes to sanctions. And let me just say a few things. You know, you'll hear on this, whenever we talk about the sanctions, the word unprecedented get overused, but purely from a sanctions perspective, this was an absolutely unprecedented situation. In what sense? The volume, the sheer volume of separate sanctions that banks were reading and interpreting and applying. Russia had, prior to the war, something like 2,700 sanctions, individual pieces of sanction. By April, we were down to 7,000, and now we as a firm have stopped counting them. Russia, by that stage, had more sanctions imposed on it than Iran, Syria, North Korea, Venezuela, Myanmar combined. Right, so that's just a huge body of rules that have to be taken by financial institutions and operationalized. I would say the breadth was also unprecedented, right? So there's sort of typically, you know, two broad categories of sanctions. You know, here's a list of individuals or corporates that we shouldn't do business with. Those are relatively easy to operationalize at most financial institutions nowadays. Sectoral sanctions are a lot more, or de-swifting, or some innovation around sanctions, around things like limits on deposits. Those were unprecedented. We hadn't done sanctions like that. So just the ability to sort of operationalize them quickly was a bit of a challenge. And then just the speed at which these sanctions came out. Again, you know, it's unprecedented. You know, in the first 30 days, almost every day, there was some form of sanction that had to be taken from rules and operationalized, and to have kind of make it real. Yeah, and the other thing to add on top of this is most EU financial institutions, are following EU sanctions, but they are also often for either regulatory reasons or just their own risk appetite, following Swiss, US, UK sanctions, etc. Right, and so even though broadly speaking we saw a lot of convergence and cooperation, they are subtly different, and those subtle differences matter when implementing. How did we cope? How did the sector cope in sort of of implementing these promptly? I think it was helpful that there was some preparation time, right? So of course we didn't know the details of all the sanctions, but many banks I think were anticipating this. There was a long lead in time, so that was quite helpful for us, I think. Like I say, to the extent that some sanctions were innovative, which again is good from a public policy perspective. We ended up at times having to put in manual controls. There's often some interpretation, even though I think public policymakers did a very good job of trying to make sure there was sufficient guidance out there. Nevertheless, there is always some level of interpretation and judgment that needs to be made. And no bank on an issue like this wants to get it wrong. So to the extent that there is interpretation, there's always the risk of on erring on the side of caution and taking a slightly more conservative approach. I think the other thing to sort of bear in mind is there is just a sort of shortage of people, right? There are sanctions is a very specialist area within banks, and we have people to do it, but to kind of cope with this volume, this is quite a specialist area, both within financial institutions and I think with some of our customers, that having the people who had the sort of expertise to be able to interpret and operationalize was a bit of an issue in the early days. I think another thing that, looking back, and by the way, things are now much calmer and under control. The other thing to sort of bear in mind is that as financial institutions, when the war in Ukraine occurred, we weren't just implementing sanctions. There were a number of other things that financial institutions were all of a sudden having to adapt to, things like the cyber risk, as important pieces of economic infrastructure, where, we were clearly potentially more vulnerable. So that was an area that people were sort of senior management time going on. Credit exposure, we have customers who have exposure. How does that affect us as lenders? In some cases, even sort of prudential risk. As financial institutions, we also, we manage our reputational risk, right? So, as the geopolitical situation changed quite suddenly, reputational risk and your assessment of it changes. So as you would have seen in the greater economy, there were many cases where something may be permissible under sanctions, but corporate boards throughout, Europe and elsewhere were saying, actually, do we want to do this business? And in some cases also having to sort of anticipate, these are the sanctions today, but what might be coming down in the future, and what decisions do we need to make today in order to kind of accommodate what might be coming down later. So for sure, it was a busy period. I think there were some impacts. So for example, I think one of the most common impacts that we had again across, I think, peer institutions as well, was payment processing slowed down quite considerably. Wherever sanctions easy to implement, we often have automated ways of doing that. But where you have to look at a payment and say, is this the export of a luxury good, right? That might involve slowing the payment and asking the customer more questions. So slowing down payments at the very time when our customers wanted us to be processing payments pretty fast, because they were having to take a lot of corrective or adjusting actions. So I think that was definitely something that was an impact. I think overall, I think, firstly, financial institutions over the last, many years have invested a lot in their financial crimes controls, particularly sanctions. So I think the sector was in a better starting position. I think generally speaking, the sector's done well. I don't think there's any sort of real obvious lessons to be learned. I think public authorities, I think they did the best job that they could do, and our job was to accommodate and react and do what was required. And I think generally institutions have done a good job of that. So overall, I think, in a sort of better position. I think my focus, and I think many of my peers' focus now as we look forward, is now focusing more on the potential various ways in which sanctions evasions could occur, etc. How do we proactively identify those scenarios? What can we do to stop that from happening? So I think that's our sort of forward-looking focus.
Thank you, Satnam. I think I have a couple of questions for you, but let's save that for the discussion. Let's now move to Timothy. Of course, you're following the sanctions debate also very closely. What are your views on what it has been and where it should go?
Thank you very much. So I served in the first cabinet of Zelensky and currently serve as an advisor. So I'm going to have probably a perspective from Ukraine on the sanctions. But I also work at the University of Pittsburgh as an economist. So this is a mixed background. I think we don't hear enough the discussion about what the ultimate purpose of the sanctions is, and I think different people put different angles into this or views, and I see at least four. One is Russia must be punished for what it's done in order to create incentives not to do it in the future. So the objective of the sanctions should be probably to prevent divorce. The second objective could be, or should be, to make this war unsustainable. And the third objective is to create incentives for Russia to stop the war. And I think putting these three objectives together is very, very difficult. So right now, Russia doesn't have much of an incentive. At least this is what we hear sometimes in informal, whisper, either from intelligence or from people who negotiated, that Russia is saying that we have already paid the price of sanctions. Now we demand the best possible settlement for us because, we can go on. The economy is adapting. We have withheld the main shock, the first shock. And so now, we can go on. And so that suggests that there should be a steepness or some kind of increase or expectation of increase in sanctions in order to continue to create incentives for Russia to think about stopping the war. Or alternatively, Russia might be expecting that if they come to a ceasefire or if they negotiate some kind of settlement, sanctions would be removed. But if that happens, then the territorial integrity of Ukraine will not be restored even to the 21st of February. And so this becomes a very difficult political question. So I think we are facing the sustainability of sanctions, the speed of increase of sanctions, and the question is, if there is some kind of negotiated settlement, even temporarily, what will happen with the sanctions? So how does Russia get out of sanctions? I think that needs to be clarified. Then it would be clear for everyone what's the end game with sanctions is. And I think otherwise we'll be focusing on the cost of sanctions all the time. There will be political pressure to create more sanctions as long as the war continues. There will be political pressure to drop sanctions because it's really costly, and that will be polarizing Europe in many ways, and also maybe creating conflicts within the US and so on and so forth. So that's not a good outcome. So I think it would be helpful to talk about the strategy behind the sanctions and the end game. How does Russia can get out of sanctions? It's a difficult conversation, but I think we have to have it. Now, in terms of the effect of the sanctions, more than 40,000 40 countries have joined the sanction coalition. So this is truly unprecedented, as everyone has mentioned already. Currently, yeah, we didn't stop counting. I think Sanam said that you stopped at 7,000. I think we currently have 10,000 sanctions. Just the sheer amount, the number of sanctions to be enforced, this poses an enforcement issue, but it's unprecedented. Just the sixth sanction package will deprive Russia of more than 90% of oil exports by the end of the year. So the impact of sanctions on Russia, if we look at the punishment strategy, has been significant. About 10% of GDP is the average forecast of the loss during in this year. Inflation rate is at 20% plus. The foreign economic transaction, the trade is reduced by 20-30%. And Standard & Poor's and also domestic analysts, the Russian domestic analysts, believe that it might take up to 10 years for Russia to recover. The oil production fell by about 10% in April, and it's currently at 1.3 million barrels below Russia's quota in OPEC. The Russian oil Urals currently is traded at 30-35% discount on the market compared to the Brent. And gas supplies from Russia to the EU have already fallen by more than 30% since the beginning of the year. However, Russia has been able to earn over 60 billion euros from sales of gas, oil, and coal. from the beginning of the year, with the EU being the main trading partner, and and it followed by China, and interestingly by Turkey. Turkey is the third largest importer of energy from Russia. Also, many large European consumers agreed to pay for gas in rubles. And in May, oil production in Russia has begun to grow back. Not significantly yet, but it's at 1%, about 150,000 barrels. This year, Russia will continue to run actually unprecedented budget surplus, about 30 billion, despite the asset freeze. So 230 from 2 to 300 billion dollars. This is an expected surplus that will be run by Russia, so it can continue to finance the war. The Russian central bank has reduced its reserves, so is forced to spend some funds, but it's it's about 10%, 52 billion down from around 60 billion before the war. And I think it's important that the Gazprom bank has become the new de facto central bank. A lot of transactions are going through it. The National Welfare Fund of Russia has increased its wealth by $43 billion, and it's currently at around $200 billion. The devaluation pressure on ruble is not there anymore. It's actually appreciates. And the key rate by central bank fell to pre-war levels. So the central bank adjusted its monetary policy, and the first shock, while it was extreme, the Russian economy has adjusted. And now there are ways for many companies to start trying to bypass sanctions through opening accounts in neighboring countries and opening businesses. At the same time, trade sanctions have been very successful. More than 1,500 companies operating in the Russian market have partially or entirely left Russia or suspended investment in Russian assets. And about 50% of Russian merchandise exports fall on the countries that have deprived Russia of the status of the most favored nation and increased tariffs. The Russians' merchandise export of $115 billion is under US and EU sanctions. And the number of container vessels in Russian waters decreased by 60% compared to November. At the same time, sanctioned goods enter Russia via Turkey, United Arab Emirates, and some other countries. The sixth sanctions package introduced the embargo on oil. So it's a turning point. And also a ban, there is a ban on the insurance of Russian oil tankers, and it will increase effect. Of course, there will be a substitution trying to use non-Russian oil tankers. At the same time, there are distractions and delays in tightening sanctions, and gives Russia opportunities to adapt and find workarounds. Fundamentally, in our view, as long as Europe remains dependent on Russian resources, the Kremlin will try to use these resources as a strategic warfare tool to pursue its objectives. And in that sense, there's this fourth objective of the sanctions, to solve the collective action problem, to make the EU and make North America, well, the EU in the first place, less vulnerable to the Russian usage of economic tools as strategic weapons in their foreign policy objectives. So I'm a part of the Yermak-McFaul group, which is a sanction group under the president of Ukraine. And this is a group of international and Ukrainian analysts and opinion leaders and economists and lawyers who work and suggest different mechanisms for sanction regimes. And in our view, the seventh package of sanctions should start thinking seriously about the restrictions on Russian gas imports, and it can take different forms, from including some mechanisms of taxation, or temporarily freeze of assets, disconnection from SWIFT of all Russian banks with a focus on Gazprom Bank, new trade restrictions which will make it impossible to run business in Russia, and secondary sanctions would need to be introduced to close workarounds and loopholes around the existing sanctions. And I will stop here in the interest of time. Thank you.
Thank you very much, Timothy, for giving this nice overview of your views on the developments with sanctions. Maybe turning back to Michael, you have now listened also to the other speakers. Of course, you're on a daily basis working very hard on new packages and so on. When you look, for instance, at what Timothy said about the objectives of the sanctions, what are your views on that, as well as an aspect that came back also in the various interventions is the collaboration with, say, the EU allies, as well as what to do with those countries that are, for instance, facilitating to some extent or being those converting routes for the EU, whether there are also initiatives on closing those. Thanks.
Yeah, thanks a lot. No, it was very interesting to hear the practical implications. I mean, when it comes to the question of the objectives or the goals, I think it was very well outlined by Timothy. This reflects very well what actually we intend to do. So, of course, first to deprive Russia from the ability to continue the war, conduct the war. Yeah? Also to make sure that there is not another round at another place happening. Of course, the incentive to stop the war immediately would be the best result we could get. However, we also need to see the reality. So I think the sanctions aspect needs or requires a long breath. So it's not something short-sighted, and we also see, and I guess from OECD angle, this can also be confirmed, the sanctions do not hit at the very moment when they are adopted or implemented. It has a time lag. And depends on the sector and depends on the area we are covering. This comes into play, or this is visible then at a later moment. Of course, it was also interesting to hear from the banking sector the implementation difficulties or the questions around what happens if suddenly something drops here from Brussels and how banks are then able to implement that. We have initiated from our financial services department, DG FISMA, a functional mailbox. We have issued questions and answers. So we are doing everything we can to help and support the financial sector in doing this. But of course, I see that when there is, in particular, when it comes to resources in the banks, okay, there are limits for us. But we want to make that as smooth as possible. So also with IT tools to help that certain things are simply done automatically. But there, the interaction, and I think I mentioned that before, the lessons learned, we need to take into account. This is a developing area. Yeah? As I said before, 2014, we gained some baby steps experience. Now, this is the first fully fledged application of the toolbox. So there, of course, we need to see what we can do better, where we can recalibrate, where we can also be of more interaction with business upfront. You raised, of course, a crucial element, and I also hinted to that before. There are, somebody mentioned this, roughly 40 countries joining us in our sanctions regime to a more or less extent. But there are quite some other countries who are not following. And of course, that limits the impact. And there are others who are even facilitating, as you mentioned, the trade with Russia, or call it circumvention, or the way around us. And of course, that is not helpful, and we need to address this. Although also there, our options are limited. But I think their straight language is, of course, important. But that diplomatic outreach is, as I mentioned before, in particular to countries where this is important. I mentioned India, Turkey as another one. I think we need to do more. And we also need to help. When I see there are dependencies of such countries from Russia in terms of goods and services, we need to see whether there are possibilities to step in and to give a helping hand to get out of that dependency of Russia. But that is, of course, more a long-term, medium to long-term project, not a short-term one. So fully agree, challenges remain. And we need to make sure that that group of 40 doesn't just talk to itself. We need to make the outreach and make clear that we want to achieve something for the good of the world.
Thank you, Michael. With that, we have come almost to the end of the webinar. I now hand over to Carol for the closing remarks.
I could add a question. Thank you, Willem. I mean, there was a question in the Q&A, Michael, that we have, in fact, through sanctions, increased the prices, and that also Timofey was saying this. The revenues for the Russian state have increased rather than declined. What do we do with this? Meaning, how do we respond to this?
Yeah, I mean, that's of course the difficult line to take. That this comes without any pain for us. It was clear from the outset that is not the case. So that it also hurts us, that it also makes for our business, but also the citizens' life more difficult, was clear. The extent, of course, in particular when it comes to energy prices, and it's not only the war in Russia that increases the energy price, and certainly it's not only the war in Russia which increases inflation, but it gives another push. And of course, there the narrative and the spin given that everything is due to the war of Russia in Ukraine, that we need to counter as well. So it shouldn't be, or we shouldn't give the impression that now the war caused everything and nothing was there before. So the root causes of the problems are different ones, or not only the war in Russia. But indeed, one thing, and what we need to avoid, and in particular when it comes to fossil fuels, that a ban, for example, of oil to the EU should not lead to an increase as they sell it somewhere else to a higher price. So, but there the commodities are of course different. The coal market and the oil market function differently from the gas market. That we have to analyze, and there we have to see what we can do in terms of negotiations. And there I would also make a plea that we should have a European approach, not each and every minister of economy, trade, energy, whatever, runs now to the LNG countries and buys some BCM. A more European approach would be helpful to limit what is there on price increases. But indeed, the big question is how and what to use and how to calibrate the sanctions to avoid that actually the revenues for Russia increase.
Okay, thank you. And also thank you for insisting that it's also an issue of the member states having a joint approach, which is something you'll certainly see from your side. Any final quick comment from Caroline, Satnam, or Timothy? Very brief. If not, I would like to thank you. Thank you, certainly, Michael, Caroline, Satnam, Timothy, and also my colleague Willem, let's say, for an interesting seminar, and also for giving this perspective on where we are. Let's say we have touched a lot of ground, and we certainly continue to follow this up. So reach out to us. Let's say if you can follow this up from our perspective, we will certainly comment upon this. But as you said, Michael, it is fairly unprecedented, but also others mentioned this, Caroline and Satnam, what we're doing, but of course it raises to many problems. So thanks a lot, and hopefully we can connect again. Bye-bye.